Okay, let's unpack this. NTPC, the big player in India's power sector, they've just released their Q1 FY26 financials. That's for the quarter ending June 30, 2025.
Right.
And while looking at them initially, some of the numbers seem a bit puzzling, maybe?
Yeah, a little counterintuitive at first glance.
Exactly. So we've gone through the detailed sources, the official unaudited statements, the audit reports, even a really good set of questions that got us thinking.
Hmm.
And the mission here for you is really to get past those surface headlines. We want to understand what's really driving these numbers.
Let's do it.
So, jumping right in. The big surprise, maybe, is the top line, revenue from operations. It actually went down in Q1 FY26 compared to last year.
Right. Both standalone and consolidated.
Yeah, standalone dropped from about 44,400 crore to around 42.5. Consolidated, similar story, 48.5 down to 47,000 crore, roughly.
So revenue's down. You see that. And for a company like NTPC, you think, what's going on?
Exactly. But here's the kicker. Profits actually went up.
Yes.
How on earth did they pull that off? Revenue down, profit up. Seems like some kind of financial magic.
Well, it's fascinating, isn't it? You look closer, and standalone profit, it rolls from about 4,511 crore to nearly 4,775 crore.
Okay.
And consolidated profit jumped too, over 6,100 crore from around 5,500 crore last year. EPS, earnings per share, that also improved.
So how? What's the secret sauce?
Well, the biggest single factor really was a pretty significant drop in their fuel costs.
Ah.
Standalone fuel costs, for example, fell by over, 2,400 crore? That's huge.
Wow.
Yeah, that's not just random luck. It points towards, better efficiency, maybe better sourcing, perhaps lower global prices playing a role too. But managing that core cost so effectively, that goes straight to the bottom line.
Right. Makes sense. Less cost to make the product.
Exactly. And then there's another piece, a bit more technical sounding. It's called the net movement in regulatory deferral account balances.
Okay. That sounds like accounting speak. Break that down for us.
Yeah, it does. But think of it like this. Sometimes, because of the specific rules set by the regulator, SIC, the Central Electricity Regulatory Commission, certain costs or revenues can't be recognized immediately in the profit and loss.
Okay.
They get parked in these deferral accounts. Then, when the rules allow or conditions are met, they can be moved into the profit statement.
Got it. So it's like money they earned before but couldn't officially count until now.
Pretty much. And this quarter, there was a positive movement. They could recognize about 1,900 crore standalone and over 2,000 crore consolidated from these accounts.
So that gave profit a nice bump, too.
A significant boost, yes. It's recognizing legitimate earnings that were previously deferred due to the regulatory framework.
Okay, that definitely clears up the profit side. But it makes me wonder, how much of that revenue dip we saw at the start is actually because of those same CERC regulations? It feels like the rules themselves changed things.
You've hit the nail on the head. That's absolutely critical here. There were new CERC tariff regulations, the 2024 ones, which kicked in on April 1st, 2024.
Right at the start of their financial year?
Exactly. And these new rules changed how they bill for power, specifically the components. You've got capacity charges. That's like a fixed fee for being available to supply power.
Okay, the readiness fee.
Kind of. And then energy charges, which are based on the actual electricity used.
The variable part.
Right. Under the new rules, the capacity charges are still billed provisionally based on the old tariffs for now. But the energy charges, they have to be billed strictly according to the new 2024 regulations.
Did that make a difference?
It seems so. The billed energy charges actually decreased compared to last year. Standalone, they were down by almost 3,000 crore.
Ah, so even if they generated similar amounts, the way it was billed and recognized under the new rules led to lower reported revenue for energy this quarter.
Precisely. That directly contributed to the overall revenue dip we talked about. And there's another layer, too. There's some estimated revenue from earlier years, mainly linked to those capacity charges. Over 1,000 crore standalone that they can't bill yet. They have to wait for what's called a true up order from CERC. That's when the final approved tariff rates are confirmed.
So again, it's revenue they've sort of earned, but the paperwork and regulatory process means it doesn't hit the books this quarter.
Exactly. It impacts the top line now. Even if the underlying business activity is strong, it's an accounting and regulatory timing issue, really.
Wow, okay. That regulatory angle is huge. It totally reframes that initial revenue number. But let's look beyond that. The revenue breakdown also tells a story about where NTPC is headed, doesn't it? Like diversification, cleaner energy.
Absolutely. You dig into the details and you see some interesting trends. Energy trading, for instance, that brought in over 1,000 crore standalone and more than 2,300 crore consolidated.
So not just making power, but actively trading it too.
Right, optimizing the market.
Yeah.
Plus, their subsidiary, NWN Ltd, had export sales to Nepal and Bangladesh over 226 crore consolidated. Shows that regional footprint. But the really telling part, I think, is the growth in solar and wind power revenue. Consolidated, that was up over 16% year on year. Went from about 658 crore to 767 crore.
Okay, that's a clear signal. They're really pushing into renewables.
It definitely looks like an accelerating trend, yeah. A strategic focus.
And speaking of strategic moves, there was also mention of separating the coal mining business.
Yes, that's another significant development. They're planning to hive off their coal mining operations into a wholly owned subsidiary, NTPC Mining Limited, or NML.
Okay, why do that?
Well, NML was actually set up back in 2019 for this purpose. The idea is likely to streamline those operations, maybe give them more focus, potentially even attract separate investment down the line.
Right, allows NTPC corporate to focus more on power generation and renewables, perhaps.
That could well be the thinking. The board approved the transfer agreement last August. Now, the interesting footnote is that the actual transfer hasn't happened yet.
Oh, why not?
It's waiting on certain conditions to be met, approvals, that sort of thing, bureaucracy, logistics. Transferring assets like land takes time, though they mention land mutation is ongoing.
So it's in progress, but a complex move.
Definitely. A major restructuring like that doesn't happen overnight.
Okay, so we have these big operational shifts, the regulatory impacts. What about the underlying financial health? Especially, debt. How are they looking there?
Actually, very solid. The key ratios paint a pretty healthy picture.
Such as?
Well, their debt-equity ratio, standalone, actually improved. It went down from 1.18 last year to 1.10 this quarter.
Meaning less reliant on debt compared to equity.
Correct, which is generally seen as positive. And their interest-service coverage ratio, standalone again, is strong at 4.05.
So they can comfortably cover their interest payments multiple times over.
Yeah. Exactly. Plenty of headroom. And it's also worth noting how they used the money they raised recently. They issued non-convertible debentures, raised about 12,000 crore in total across 3 tranches.
Okay.
And the reports confirm that money was used exactly as planned for capital expenditure, refinancing older loans, and general corporate needs. No deviations.
That shows good discipline. People lending them money want to see that.
Absolutely. And for those lenders or potential bond investors, the security is strong too. They maintained 100% or higher security cover for their secured debt.
Meaning?
Meaning the debt is backed by specific, valuable assets. Big power stations like Daidri, Vintikel, Sapat, Bar, Solapur. The reports even list the book values of the assets pledged.
So lenders have concrete assets backing their loans. That provides confidence.
It definitely does. It points to a well-managed balance sheet.
Right. Now, digging really deep into those notes, there are always some older, lingering issues, aren't there? I saw something about a discontinued hydro project.
Yes, that's a long-standing one. There was a hydro project where construction was actually stopped by the government way back in 2010.
10 years ago. Wow.
More than that, yeah.
Yeah.
And as of this quarter, June 30th, 2025, there's still about 439 crore outstanding that NTPC believes is recoverable from the government of India for costs incurred on that halted project.
And is that straightforward, recovering it?
Well, it's complicated. A chunk of that, about 251 crore, is tied up in arbitration awards that NTPC itself is challenging. So there's legal back and forth. But the management stance, as stated in the notes, is that they expect full compensation eventually from the government for all the costs.
So it's a known issue being managed, but it highlights the long timelines and complexities you sometimes see in this sector, dealing with legacy projects and government interactions.
Exactly. It's part of the reality of operating at this scale in this industry.
Yeah.
But if you connect it all, the big picture is NTPC navigating this really complex environment quite effectively. They're managing current operations, adapting to new regulations like CERC, strategically shifting towards renewables, hiving off non-core assets like coal mining eventually, and also dealing with these long-tail legacy issues like the hydro project, all while keeping their finances, like their debt ratios and coverage, looking pretty strong.
So the implicit strategy seems clear then. Keep driving efficiency, manage costs like fuel really tightly, push harder on renewables and diversification, and maintain that financial discipline.
That seems to be the playbook, yes. Cost control, strategic shifts, and financial prudence all working together.
This deep dive really underscores it, doesn't it? You can't just look at one number like revenue.
Not at all.
You have to see how things like cost control, like we saw with fuel, and these regulatory accounting changes, like with CERC, dramatically affect the reported profit.
Right.
And it shows how they manage that feet-boosting profits, even with lower reported revenue, mainly through that cost management and navigating the regulatory landscape, while clearly steering towards a cleaner, more diverse energy future.
Absolutely. And analyzing it this way, getting into the weeds of the financials and the regulatory context, it reveals so much about how a major player like NTPC operates and adapts.
Yeah.
And maybe it leaves you, the listener, with a question to think about. How do these specific insights into NTPC, their resilience, their strategic shifts, how they handle regulations, how does that shape your view of the broader energy transition? Not just for this one company, but for the entire power sector as it faces similar pressures and opportunities.